theirs. So I put in parentheses internal, whether you choose to build a business plan that's that thick and share it with anybody, or it becomes your internal manifesto that you never share, but it's always something that you're continuously enhancing. Either way, you need to have that. And we'll talk at the end of this about what actual things you need to be able to be prepared to show people with all that. I'm also going to assume that you have an all-star lineup. Now, when I say all-star lineup, I'm not talking about necessarily people that are famous or that have done this before or anything else like that. But there ought to be some compelling reason. If you're asking me for money or someone else for money, there should be some compelling reason why I should be confident in you. So maybe you're an all-star in that tiny little area that's relevant to this business. That's what we want to see. So I'm going to assume, again, for this conversation, that you've done that. You have your all-star lineup in place. And then this last concept, there's definitely this concept of what do I need versus what do I want. And you have to understand both of those, because you may not need anything. You may have everything that you need to do to make your business successful. You just need to execute on it. That may be the need. The want is, oh, geez, I'd really like to have $2 million sitting in the bank. I'd like a runway of 18 months and blah, blah, blah. By the way, all good things to have, but you got to reconcile the two. You need to understand both ends of that. My favorite line, when you're looking out to go raise capital, hopefully you've got an existing business. It used to be back in the 1900s, 1990s, that one, that if you had an idea, you got funded. Well, of course, that produced a bubble, and that doesn't happen so often. Now you actually have to have a viable business. We'd like to see success. We'd like to see customers. We'd like to see revenue, strategic differentiation. And again, we're going to cover a fair amount of these things in this conversation. But my favorite thing is, focus on generating revenue. Number one thing is if you focus on revenue, it may mean that you don't need to raise capital. It also may mean that when you do raise capital, you get a better valuation. You get to set better terms. So don't ever underestimate the ability to generate revenue. So if that means that I'm going to spend 90 days going out and raising capital, and that's going to be my number one primary focus, that may be the right thing. But maybe also in that 90 days, if you increase your revenue, or got revenue, that may impact positively not only your business, but your ability to raise money. Okay, so the overall investment potential, and I have in parentheses an ongoing assessment. This is another one of those things that is one of those internal metrics that you always, as a business person, want to understand and always be updating mentally. Whether you're actually out there raising capital or not, if I did, am I ready? Have I optimized all the opportunities? And you may find that, again, I'm in such a great position that I actually don't need to raise capital, or if I do, I get to do it on my terms. And this is an ongoing, always, forever process that continues. So again, we talked earlier about some of the assumptions, the opportunity. You found some killer hole in the world, and you've come up with this great solution. So again, without getting into the specifics, if you can't demonstrate those two things, meeting over. So, and again, you should be questioning yourself. Is this a viable business? Is this a real opportunity? Do I have a real solution? Those kinds of things. So again, we're making assumptions that we've gotten there. That's why I separated those. So ultimately, from an investment potential, the ultimate kinds of things that we're interested in is, well, okay, so what do we got? What's here? So what are the existing properties? What assets do we have? What cash do we have in the bank? What advantage do we have from technology that we've already created? What agreements have we created that gives us subsidized access to resources? Whatever they may be. I went to my friend and he and I cut a deal and we're willing to work for a third of what we get out in the public market. That's an asset, assuming it's real. So again, one of the things that we as investors are going to do ultimately when we start looking at things like valuation is, okay, what's there? What's tangible from that end? So also, market size is kind of one of those interesting things. It really depends on the investment base. The general investor base, I think, wants to see very, very large markets that we can go out and get a little teeny piece of. Because if you come and tell me that, oh, this is a $12 billion market and I'm going to get 20% of that market the first year, meeting over. So if you can show me, however, that you have a model that can get a tiny little piece of a very large market, that excites me a lot. And again, I'm interested in looking further. There are exceptions. The vertical markets are a great example, and there are vertical investors as well. If you've got a product which isn't, and I hesitate using the word mainstream, but appeals to a specific vertical sector, a narrow market out there, and that market may not be a multi-billion-dollar market. It may only be a $300 or $400 million market overall. Of course, I'm interested in what's the growth of that market, because that $300 million market may be a $1 billion market 3 or 4 years from now. And if you can then go in and show, well, all right, here's a market that I've created something, and it's going to revolutionize, and I'm going to be able to get a little piece of this, and that little piece may be a larger piece. Again, for the right investor, that's still okay. It doesn't have to be a $1 billion market. But again, you have to understand that it takes time, and it takes money, and it takes differentiating technology, product, management to be able to get more than a half a point of market share. So you need to be able to demonstrate all these kinds of things as well. So the timing, if you're thinking about, again, this is the whole concept of investment potential. This is really something, this is one of those metrics that you guys should be keeping track of. Is my company, what's the current investment potential? And if you can put a number on it, some rating, arbitrary rating that you make up. What is, well, today I don't got diddly, so it's probably pretty low, right? On the other hand, now, next week I've got $30 million in contracts, and I've got $1 million in the bank. Well, my investment potential has a higher rating. Always be conscious of what this is, and make sure you include this in your thought process as you're making decisions about what to do and where to go, how do you invest your time, how do you invest your resources with all this. From an investment perspective, I'm going to be interested in things related to timing. Okay, so what kind of round is this? Is this an early stage round? Is this a follow-up round? Is this an up round, meaning the last round you did, is this now worth more? The valuation go up? Is this a down round? Is it neutral? Those things all tell me things as an investor, and I'm interested in that. You should know these as to what specifically where you are in that investment process. So, and of course, the one that that you guys hate to see is we're investing because we're in distress. And what does that mean? It's really simple. If I don't raise this money, I'm out of business. Not the best opening conversation to raising money. Although, again, there are investors out there in the community that's the kind of deals they like to do. Trust me, you don't get to specify the terms. You get to say thank you when they hand you the money and take over your company, basically. Not quite like that, but yeah, maybe. Also, we're interested in overall synergies that exist between you and the business you're in, whether it's be your customers, the investors, and synergy in that regard. If I go to if I'm specializing my product in dog food and I go to an investor that doesn't like dogs, probably not a lot of synergy there. Although money trumps dog love, so there's that balance. But still, be thinking about all of those elements as well, because those become relevant, and ultimately those become sort of those intangible value components that nevertheless we as investors are still interested in. So, risk. Ultimately we're gonna look at the risk side lots, and you guys, we want to know that you understand the risk components. And it's not by accident that when you actually do a formal financing, that the financing part's this big, the disclosure part's that big about all the risks, and this might happen, and a meteor might fall, and blah. So we all may wake up and decide we don't like water. So whatever the risk factor is, it gets really extensive. But you guys need to understand that, because again, if you make it to that next conversation or the follow-up conversation with the investment group, and they start throwing these things out at you, you better be able to respond. Well, you know what? It is absolutely true that may happen. And here's what our strategy is for dealing with that. And think all that stuff through. Again, the overall investment potential is, I'm an investor. I'm out here to make money. I'm not a bank. I don't loan money. I don't do it for 9%. I want to see 10x minimum in my return. So, what's my reward with all of that? Now, that factors into lots of things. What's the likelihood of this thing happening? What's my piece of it? What's the starting valuation? What's the anticipated valuation? What's the likelihood that we're going to get to that valuation? And all those things that go along with that. So again, if you can't get my interest in these things, and by the way, just to get to there, you've been through so many questions and so many points. If you haven't studied, if you haven't done that research, if you don't have it ingrained in you, you're not going to be able to answer all those questions. And 99 times out of 100, meeting over. Okay, and the other thing you always have to be thinking about, and this is part of the balance of calculating how much do I need and what am I willing to give away for it, is you're asking me for $1 million. What else can I do with that money? And I'm not talking about going and buy a boat and going on vacation. if you tell me that you've got this great business plan, I'm going to pick on you, you said up front, so if you tell me you've got this great business plan, and you need $1 million, you're going to do da-da-da-da-da, okay, and you're going to own this marketplace, and you didn't get me to sign an NDA, not that I would have signed one, but in any event, and instead of giving you that $1 million, you're only going to give me 10% of your company, I go over here and say, I'll put this money to work over here. Now again, assuming that that's okay, not that I'm asking for your permission, but if there's no legal impediment for doing that or no moral or ethical issue with all of that, you have to think of where else might I deploy my capital, and if I've got choices, why you? Because again, if you can't answer that question, there's another strike. So I think I'm even that. So, all right. This was the wordiest slide, so sorry about that. I didn't pick the topic. I didn't even pick the bullet item, so it's a little bit random. But it's all related, actually, as it turns out. So that's okay. So, again, we're making all these assumptions. You got the greatest thing. I want to know about what is the competitive differentiation. That is yes, competitive differentiation. Big math word I get to use. I never get to use it with math, but I get to use it with business all the time. So my competitive differentiation, what's so special about what you guys are doing? And it's literally just this. But before you do that, and this top bullet item doesn't really fit in this slide, but you can't really go here without understanding this concept, okay? I'm going to invent a product that is going to make everybody in the world their life a zillion times better. Every single person. I'm going to go market to every single person on the web. What mountain did you just define that you're going to go own? I think it's called Earth. And again, if you've got the budget, if the product's that sexy, go for it. And by the way, if you do get a product that's that sexy, please call me. But seriously, one of the biggest challenges you have as an entrepreneur is about focus. Because it's easy. Trust me, it's actually easy to come up with 1 million ideas that could make $1 million each. Executing on one of them, now that's a different story. That's tough. Okay? So the thing that you need to do is think about focus. And not just in any one of these slides, in every single thing you do. You should always be asking yourself that question. Is this thing right here relevant to what I'm trying to accomplish in my business? Because if it's not, it's a distraction. And it's literally that black and white. So one of the things that you need to do is figure out, okay, what mountain do I want to go own? I want to climb it. I want to hit the summit. I want to stick my flag in it. And I want to look down and go, this is mine. And nobody can touch me. You got to think about that first. Then you got to ask yourself, does somebody else already have their flag in that mountain? What are you going to do to toss their flag out? What are you going to do once you get your flag and then keep somebody from tossing your flag out? So think in terms of that. What mountain do you want to own? When you own that, then you can talk about what mountain range do I want to own? And then later Earth. The rest of the stuff's pretty straightforward. Again, if you can't tell me what's so special about all of this, well, if you can't answer that, how do you think I'm going to get excited about all this stuff? All the elements that go along with that, the advantages. What's going to prevent you from going out and raising money and competing against me and taking my market away? Have I created any barriers of entry? I know I'll come back and tell you, but actually, I can see really good far as close up. IP is one of those interesting things. I actually have patents. I'm also a member of the Open Web Foundation, which is an anti-patent group. Trust me, it's an interesting challenge. I actually ran the elections for the board, and I've been in some interesting conversations with that. There's a balance. I personally, on the one hand, forget the fact that I actually don't patent. On the one hand, patents aren't as important to me. Because, especially in software. Now, in non-technology businesses, in hardware, in other types of products, absolutely. You got a patent, I can lock in that market, great. Okay. Now, that's not to say I'm against software patents, but again, it's a focus issue. Ultimately, if you've got the cash and you've got something that's patentable, please go patent it. But don't turn your business just on that. My focus on revenue, ultimately, is my number one goal from that end. But it doesn't hurt to have these things. And unless you're a patent troll, that shouldn't be your number one goal. So there's only so much room for patent trolls. And if you're a patent troll, raise your hand and we'll help you to the door. No? Okay, cool. And again, competitive analysis, I put in parentheses ongoing, because this is another one of those metrics. If you don't know what your competitors are doing, And more than that, if you can't anticipate what they're going to do, you're at a weak state. This is something that you always have to know what's going on. Okay, so if back in the PC Magazine Editor's Choice Awards days, when they would set up a grid and they would go, this product and this company, this company, this company, and here's the checkbox, and blah, this guy wins. You should still be doing that every day. Still understand what's that feature benefit that you provide versus the other people that are perceived competitors in your space. And again, whether you show that to anyone, and by the way, this should be part of your marketing strategy and your investor pitches and things like that, but whether you show it to anybody, you need to know this. And again, not just where we're at, but anticipate where everybody's going. Because if you can't anticipate the market, you're already dead. You just don't know it yet. Okay, so ultimately, the kind of differentiation value proposition, those things are really intimately entwined with all this. I like to say, what's the secret sauce? What makes you so special? Secret thing. What makes you so special? What is that secret sauce that does that? If I were to list those bullets, what are they? And I've got an example from a company that got funded. We actually led the Series A, and I'm going to show you some stuff in this presentation with them. From the day we met these guys, the day we started to check, was 60 days. It doesn't happen quite so often. I've actually done it less, but it's rare. So we're going to look at the secret sauce. And again, this stuff is pretty self-evident. What makes me so compelled? I've got to have this, right? And by the way, these are all things that ultimately drive your pitch, your marketing, some of your sales strategies, where you spend your money to get your customers and things like that. Is this a little effect on my life, or is it a game changer? Those things, all from an investment perspective, are things that I'm interested in. Because again, if you make it easier for me to unscrew the cap of that water, not such a big deal to me. On the other hand, if you figure out how to take that water bottle and make it biodegradable not before I drink it, by the way. And we have a green technology, and it's useful, and everybody here has water sitting in front of them. Okay, that's a pretty big impact in a lot of different ways. So you need to understand that as well, because ultimately, as investors, when we start adding up, A plus B plus C divided by D and blah blah blah, and come up with some valuation metric, some investment strategy, et cetera. These are some of the variables that we use. Again, viral growth is one of those things that doesn't really fit in this slide, but it is relevant because it deals with the excitement of the product, okay? And more particularly, it deals with cost of acquisition of users, which we're going to talk more about on the back end of this with that. But, we love products, and this does not have to be technology. I've seen it done with, juice drinks and, consumer products and, all kinds of stuff. You probably have all seen Jib Jab and some of the crazy videos that those guys do. What are they selling? Whatever they want, right? So, but what happens is you get this viral mechanism, and those are things that are very interesting. Not only is there some reason that I have to have it, but there's some reason I got to go tell all my friends and the people I know. If you can, and again, this is critical to be able to do this. That's not my computer getting ready to blow up. This is my phone, not completely turned off. Sorry, so feel free to let your olds buzz too, since I did it. But still, it's one of those interesting things that we like to see about that. And if it exists, wow, even better with that. It's not a critical component that if you don't have it, your business isn't successful. But you should exhaust all efforts to figure out why you can't have it before you just say, okay, we don't get this in our business. Okay, that's cool. So other factors that we think about, it's like, okay, so, all right, I can go get Britney Spears to go do a promo for me, and I can write a big check, or back in the older days, get a Super Bowl commercial. I'm one of those crazy people that did that once. And get a zillion people to come and learn about your company or your product or whatever. Big deal. I spent a lot of money. What did I get for it? Did I get customers? Did I get retention? Did they stick? Was there stickiness? Did we have those eyeballs come and stay? Did they buy? Did we get those conversions? More importantly, if I look 6 months down the road, what was my follow-up? How many people did I lose? Did they stay engaged? Are they still my customers? Do I have to keep reselling them over and over again? In software, there's a really cool holy grail of software. Microsoft ran into the opposite of this problem, and they sold you Microsoft Office. And you went, oh, that's great, I love it. And then next year they want you to buy another one. Well, no, wait a minute, but the other one works fine, guys. And so now they're in a position where they have to resell you over and over and over again, probably with a bunch of junk you didn't need anyway. So the opposite of that is the holy grail of software, and that is the recurring monthly revenue, commonly known as Norton Antivirus. Okay. Because if you don't use them, they go, you know. And I'm pretty sure they're funding virus development, but no.
It's in their best interest, that's for sure.
You know, and again, one of these that we throw in there is this fun and engagement. Okay, so you know, Facebook has it. I mean, how many of y'all are on Facebook? I'd be surprised who isn't with all of this. Actually, not. How many go on Facebook at least once a day? Yeah, so that's the engagement right there. They've created this compelling reason. And actually, they did it really cool because they don't actually produce content. You do. They're just the delivery mechanism for letting you access your own content and interacting with your friends. It's a pretty cool concept, actually, from that end. But there's an engagement, and there's a fun factor. There's this excitement. And again, if your product doesn't require any of those things, right? Somebody made $1 zillion on wheel ball bearings. Not fun, not engaging, not excitement. You know, all that other stuff. But they're sitting back in a big house, probably got a boat in the backyard and an airplane tethered at the airport. So that's okay too. But again, if your business supports these concepts, you should find out how to tap into them before you just arbitrarily say, those are not options, because they all add up. Okay, so I was talking about an example of that secret sauce. So this is a company that I was talking about earlier. They were funded 0 to Series A in 60 days. And their secret sauce, they just listed it on a single page. What's so special about what they do? Well, we do A, we do B, we do C. And then we expanded on that, kind of straightforward. And that was it. Real simple. This, by the way, the document on the left, not the document on the right, the document on the left is absolutely a great insert for your executive summary, your investor deck. We're going to talk about it at the end of this from that. Okay, so going back to the predefined topic list. Investors' view of talent. You know, this is one of those interesting things because a lot of investors will tell you that look, we don't invest in companies, we invest in people. With that. Of course, they're the same guys that sit on the board and go, well, if you don't do your job, I'm going to bring other people in to do it. So there's this balance, you know, from that end. And then I put my little corollary, companies don't run companies, the people with the money do. And we're actually going to talk about that at the very end of this, about when you go and do an investment, be aware of the consequences and sometimes unintended consequences that exist. And that goes back to the terms you have to be willing to give and the terms you have to be willing to accept, which goes to the very front of this conversation. The more control you have, the more revenue you have, the more traction you have, the more you got it, the more you get to dictate the terms. So there's this big balance that exists. So we like ICE, integrity, competency, and experience. If you're part of this thing, you're asking me to share my dollars with you. Why? Why should I trust you? Why should I be comfortable? Convince me, right? So, and I'm going to show you a slide where that sort of consolidates it. But a lot of it has to do with who you are, what you've done, where you've been. Now, you could easily make the assumption then that, oh, great, I have to actually have done a bunch of stuff to get funded. Not true. And these guys were fresh out of LSU. And we're going to show you some stuff a little bit more about that. In that instance, you can mitigate that by getting into being able to show relevance. You can get into by showing mentoring, and that's where that synergy of here's my advisors, here's the other folks I brought in, and you can tie that together. If you have had business in the past, absolutely talk about that because that's relevant. And by the way, not just the successes. We saw in the very opening slide, the title slide, a little quote by Albert Einstein. If you haven't failed, I don't remember what the gist of it is. If you haven't failed, you haven't tried hard enough. If you're not learning something, if both of those are relevant conversations. So just keep going. Red flags for us, things that don't match up to ICE. Lack of integrity, lack of competency, and lack of experience. Those are things that have red flags for us. So, you know, again, the relevance, timing, cost, all that sort of stuff. You know, golly, I've seen deals where people say, well, here's the executive team I'm going to put in. I'm going to go do this. The minute I get this dollars, I'm going to go do these hires and blah, blah, blah. Next thing I know, you went from $1 $30,000 a month burn to a $300,000 a month burn, and I haven't seen any increase in revenue yet. Now, that may be valid, but you got a long sail to convince me about it, especially today. You know, we're in an age where it is ridiculously cheap to run a startup, to run a business. Virtualization, low costs of things that used to be very, very expensive. That little thing right here, man, this little thing right here didn't exist so many years ago, but you can check your email. Yeah, check your email, send tweets, and open up dashboards and check your business. You pick $40 a month. Okay. So, I mean, you couldn't even do that 10 years ago.
You mentioned cash burn. What's the average monthly cash burn you're looking for a software startup?
If you will bear with me, we're going to get to that ugly, gory, detailed stuff very shortly.
Thank you.
I don't know if this is an average, but we certainly will talk about some variants, some specific models with that. But I am going to be interested in the timing and the relevance. I'm sorry, why are you bringing this $150,000 an hour or a year guy in at this time? Under those terms? Again, if you can't answer these questions, anticipate what we're going to ask you. And by the way, if you go, well, yeah, but he's my distant cousin and blah, 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 okay, that may be okay, but he better be a damn good distant cousin who's relevant to the business model at this time if you expect me to buy into that. Because if you try and do these crazy things that spend lots and lots of money without thinking through the process or the consequence, I'm now questioning, do you have the ability to manage my money? Right? And the fact that you got your dad to put money in is irrelevant. The fact that you put your life savings into it is irrelevant because you could be an idiot. Let's hope that that's not the case. When you bring other people's money in, you can guarantee that success brings reward, and failure of success, the opposite. So there will be accountability. Now, this is sort of one of those things in the investment community. Look, if I wanted to run your company, I would just go be in that business. But I want to put my money to work in lots of places. So I can only run so many companies. So I invest in others and I provide support. And that's what good investors do, is they try and leverage that capability. We're not out there to run the company. We want to make sure that if the train goes off the track, preferably we'd like to prevent that. Or if it does, we'd like to make sure it doesn't wander too far from the tracks and push it back up there. That's what we want to do. Okay? Because fundamentally, we are investing in you or any one of you guys, and we'd like to see you go forward with all of that. So we're trusting in your vision, we're trusting in your execution, but we're going to be monitoring, we're going to be looking for metrics. We're going to ask you, what do you think? Okay, cool, I'm cool with that. When's that going to happen? Okay, sounds great. What are the metrics that we can validate against that? Cool with that. Okay, let's let the time tick and see what happens. Because what we don't want to do is put ourselves in a situation where we put our money in, we've risked all this investment. And by the way, investors invest way more than money. We're not writing a check and saying, call us when it's worth 10x. There is an enormous investment of time and effort before we even get in the deal. But afterwards, now we're pseudo-married. And there's a lot of stuff that goes on. So it's way more than the actual dollars that are involved. So we're really interested in that. So the last comment, mentoring, megalomania, and the board. We see this all the time. So we were talking about earlier about the mentoring. Okay, it is absolutely cool to have a great business plan. Have never gone out and done this. You've been in the workplace for 20 years. Your kids are now grown, and you've been dying on this great business plan, and now you want to jump back in. Great, bring it. Okay, if you don't have that background that says here's all this experience, that's fine. Go get a mentor. Align yourselves with advisors that are relevant with all of this. Okay? Megalomania, that's that wild one. That's that guy who joins the board. He's the original founder, comes to the board all the time, and every conversation, every argument ends with, well, because I said so and I own 51%. Where do you go with that? Don't ask me for money. You're the megalomania. You go figure it out yourself. Well, so as investors, we want to make sure that that doesn't happen. So you may own 51%, but we're probably going to put some controls in there to prevent the because I said so mentality, at least for some period of time. We're going to talk a little bit more about that shortly. And the board. You don't run the company, the board does. Just saying. Okay, so when you go and this is another piece from an investor deck. Okay, look guys, I'm not looking for a 2-page resume. I may ask for that later. Okay, but as part of the executive deck, keep it concise, keep it relevant. I don't care if you ever had a giant popsicle stand, unless you're in the popsicle business. Show me the stuff that's relevant, okay? Keep it concise, make it clean, simple as that, okay? And if you keep my interest, we're definitely going to dive into the details. But as you put your deck together, your investor deck and your executive summary, and by the way, my personal opinion is the single most important outward document that you share is the executive summary document. I think Dave was talking about it earlier, where you've got, if you can't coalesce your business in a dozen pages, it's too complex. Too complex. And I don't mean lots of little print. Okay, so this was what the whole purpose of all this stuff was.
Just a quick question. We've been looking into various different VC/angel funding in the past couple months, and one thing I'm just curious what your take is a lot of times you obviously want to read through like a VC or an angel's website first to like see their philosophy, and you want to kind of customize it, but at the end of the day also, I mean, it's an incredibly time-consuming thing. Sometimes people want their exec sum in a PowerPoint form, sometimes people want it in Excel, sometimes people want it in a one-page exec sum, sometimes people want it in an 8-page. I mean, is it okay to make one kind of format that you believe, like go to like a Sequoia Capital and say, okay, well, I use their metrics and then just submit that, or should you change it accordingly?
Well, and I do actually have a couple things we're going to talk a little bit more about it, but I will respond to that. First of all, there is no standard form you go to Office Depot and buy, here's the communications to have with a VC. Because they're all different, and not just VCs, investors in general. They're all different, okay? Your job when you're pitching to anybody who's going to raise money is real simple. Get them to say no quickly. Sounds counterintuitive. No, that's it, okay? Because if you don't succeed, you've made it to the next meeting. Now, don't waste your time. Get them to say no quickly. Well, I couldn't get them to say no then. Now go to the next meeting. And lo and behold, what then happens during that process is the things that they need to see that are special to them, you'll provide them if you're interested and if they're interested. So you come up with the best conveyance that you can, and there are different methods, and again, I'll show you a couple of specific things here. There are different methods. Get their interest, and you only have so much of their time, so much of their attention. Get them to say no quickly. Oh, crap, I couldn't get them to say no. That's a good sign. So I'll address that.
So I mean, I guess, are you offended if you ask for certain things and someone sends you a different format? Are you offended by it, and is that like a total rule out, or if the idea is good enough, then it's?
Well, so you have to respect the request ultimately, because you're asking these people to put in money in, right? On the other hand, you have to weigh that against. Well, wait a second. Have I even qualified these people to determine if they're the right fit, or if they have any interest whatsoever? Is their request unreasonable? And when you start comparing all of those things, then you start coming up with a filter that says, for this guy, yeah, maybe. For these guys, not so much. So.
I found it's usually about the same, similar information, just kind of spun a little differently. So
I'm actually, from a financial standpoint, I'm actually going to address this, and then if anyone wants later, we can go into this. Oh, I don't need to move from this slide. Okay, so this is the infamous hockey stick. I heard David mention it earlier. Okay. So here, this is one of those strange things in the investment community. We all of us investors want to see this kind of growth, this hockey stick. I couldn't find the left one, so I reversed it in Photoshop. So nobody tagged me on the fact that the writing's backwards. But if you show me a hockey stick, you sure as hell better show me the details that makes it valid. Otherwise, you're wasting my time, right? Because anybody, when you do pro forma financials, you can make them do whatever you want. And I actually know people that go, oops, not quick enough. Let's go back and work the numbers a little bit. Okay? So what happens is this really becomes almost meaningless to an investor without the details behind the scenes. But trust me, if you can't show me that kind of growth, I probably don't have a lot of interest in the business. So we do want to see that. But the visual has gotten stale without the meat behind it. So don't show me a hockey stick unless you're prepared to prove it. Unless you've got the details behind the scenes. And this isn't enough, by the way. But there's your hockey stick as well with that. And it's also got some metrics in there. Whether or not those metrics should be here or somewhere else, or should have some summary information, you better be prepared to justify what you say in your statements, in information you put in your executive summary. You better be able to tie it all together. Now, ultimately, David was talking about it earlier, and I couldn't agree more. Okay, fundamentally, you guys were talking about how many years pro formas and other things like that. the fundamental thing we want to understand from a financial standpoint is what does it cost to run your business? What's the cost to produce your product? Okay, what's the unit cost? What's my cost of acquisition of users? Because then those are the core things that if you've got your assumptions wrong there, and then extend that out 5 years, totally unbelievable. So it's that whole simple concept. Start simple. Take it down to its barest essence. Follow a transaction. Go very, very low level, and keep it simple. 2 more slides from a deck. Okay? How do I make money? And then show me that sample transaction. Follow me through the process. And by the way, you should be able to do this so that you understand these, because these are the core building blocks. I don't know, what is it, that famous moon joke? Okay, so I know it. If I'm off by 1/1,000,000th of a millimeter and I send the rocket to moon, I miss by 100,000 miles. Even though I was off by that little teeny bit. Why? Because I extended it that far out. Which goes back to if I extend it 5 years, if my base building blocks are wrong, there's no way that the projections at the end are realistic. So start simple. Understand the details of it, and then build from there. Okay, so financial information that we're interested in. Now, you don't have to throw all this at us, but if you end up getting my money, these are things I'm already going to have gone through, these concepts. They're broken into a couple of different concepts. So we are interested in, it's a little bit different, as I said earlier, because the cost of doing business today is different than it was just 10 years ago. With this, I hope that it is, but it's cheaper to have a startup. It's still expensive, but we have, for $1,000, you can tap into a market that is 600 and some odd million people strong. It's called Facebook, right? But what other arena did you have access to that 10 years ago? Didn't. So it's much more cost effective ultimately. So we are interested in seeing the building blocks. I want to see how that translates to the first year. And actually, the things I'm interested in are sort of in that middle area. I'm going to be very specific about some of those things. But when we start talking about your runway, how much cash do you have and how long can you run? I want to see every financial related to that period of time with that. So how does the expenditure of money affect cash on hand and your ability to execute? And I want to see all those things. So ultimately, when I start looking at what are the elements, and again, this is, as you guys wrote this, it's what's my stuff as an investor. What do I want to see from all of that? Well, of course, I want to see overall income expense with that. But more precisely, the things I care about is I want to see if you're sliding, Uncle Fred $150,000 and made him the VP of Biz Dev when he was retired last week from, I don't know, whatever, not related to your business. So I am interested in seeing your salary structure and things like that. On the opposite end of that, if you tell me that, look, I need 5 people to start my business, and then I'm going to run it from 0 to 50 million a month, and I need 7 people. By the way, I'm capable of believing that. But again, you have a pretty good sale. You better show me where all the automation is that allows that to occur. So I'm interested on that other side as well. G&A expense, again, this is that place that encapsulates all that hidden stuff that we want to see. Do you really need that office? It's funny. I had an office in Plantation. I paid $18,000 a month for 7 years. And when the lease came up, I went, why? Why am I going to continue to do this? My guys are all over the U.S. I have a virtual operation. So I got a little office in Fort Lauderdale. I mostly work out of my house or an airplane. And I save $18,000. All right, I save $17,000 a month. That's not to say you should go out and get an office, but again, justify it, okay? Justify all of these things, and the G&A are going to be areas that we're going to look at very, very closely. By the way, when you actually do talk us into giving the money, all this crap that you tried to sell us, that we bought into, we're going to hold you to it. We're going to use that as the metric to go back. Wait a second, you said ... You better have a good explanation as to why it's not ... Which one of the best advices I can give you, piece of advice I can give you as it relates to running your business when you bring other people in, is communication. Because that stuff happens all the time. This is what I thought was going to happen, it didn't happen. Don't surprise me. Communicate with me. Help me understand what's going on. That will save you so much grief going forward with all that. Cash flow analysis. Again, so if you tell me that you need 100 grand to launch your business, right? And I go and look at the cash flow analysis and go, well, here's the problem. In month 3, if the sales you get are off by just 5%, that you anticipate are off by just 5%, you're belly up. Whoa! You mean you're putting all my money at risk and we're in and out of it in 90 days? I need to understand what the cash flow is for your business. When's it got to go out? What do you have in? What do you have available? Because that's going to tell me what money you need really and how I need to dole it out to you, which is a concept known as tranches, and that's on my last slide. We're almost done. So that becomes really, really important. So this middle section, these are those metrics that, again, are really critical to me as an investor. What is the cost of goods? Okay, I got this widget. How much does it cost? Because now I can ask questions. All right, if it costs me $2 and I can retail it for $100, that's great, but I'm not a retailer. Okay, so I can wholesale it for $250 or whatever the margins I can squeeze out of the market. These are things that I can calculate to help me determine the reality of my business and the dollars. It can also help me with pricing strategies. If my competitors are out there charging $20, $19.95 for the product, and I've got a product that's better, and I'm able to charge it at $15.95, however, their margin is 40%, my margin is 2%. Okay, well, you can take the Amazon.com model, and it's worked for them, but it's rare. So again, these help us provide larger metrics that help us understand, and it's useful to you guys as well with this, because again, before you ever go out and announce, here's my price, you sure as heck better understand all of your cost factors, all of your soft cost factors in there, and your profit. Because again, if you tell me that you want me to go to risk for $10 million, but before we do that, we're going to put $20 million of debt on the books, and our margin is going to be 7%, hard sell. Not impossible, hard sell. Okay, so the rest of these monthly burn, zero revenue runway, distance cash flow, distance profitability, capital expenditures, those are things that are critical overall for us to ask ourselves, are we being realistic about this? Again, if you tell me you need $100,000 and it turns out that in month 3, you're going to have $2,000 in the bank, which is fine on month 4 because you're going to have $50,000 in sales. That's great. Well, that's not real realistic to me. So I'm thinking you don't need 100,000. I think you need 150,000, right? So likewise, the thing I want to avoid is having to sell at distress, because when I do help with an exit, I want it to be an up round exit. I want it to be multiples, positive multiples of the revenue and things like that. I want to be able to do it on my terms. So to be able to do that, you have to be able to give yourself breathing room to execute. Not enough to hang yourself, but breathing room. So the thing that we're interested very much so is this concept, first of all, of this monthly burn. Forget revenue for a second. Don't forget that permanently, please. But just for a second, for purpose of this conversation, forget your revenue, okay? What does it cost to run your business? What's your monthly burn? And for a software company, whether that's $30,000 or $120,000, depends on the state that you're in as a business with that. Okay, that's fine. So as an investor, I'm interested in seeing a period of time where you have to execute your vision without being distracted. You sold me. I bought into a lock, stock, and barrel. Now I want to help you execute on your vision. And I want to give you the rope to make this thing successful. And I want to prevent you from hanging yourself and me along with it. So there's that fine line. So I probably will go and say, whatever your monthly burn is, multiply that up times 18. That's how much money you need. That gives you an 18-month runway. Runway being where the airplane falls off the end and crashes. Okay? So now that doesn't mean you have 18 months. No. That's how much money the company has. Okay? Because at 12 months, we're going to put the brakes on and say, stop, we need to do an assessment. Now, I guarantee we're going to be doing this every month. But there's going to be a hard stop 12 months out. And we're going to sit there and say, okay, what's going on? Have we met our objectives? Have we done the things that we need to do? Have we increased value? Have we gotten the market share? What are the pluses and minuses and all of that stuff? Because we're going to ask a very tough question. We still have 6 months of money in the bank, so we're certainly not in distress at this point. However, if we go to only 4 months in the bank, now we're starting to get on the edges of distress if we had to do something. So we want to make sure we have enough time to do whatever it is we need to do. What could that be? I don't know, raise more money. Fire you and bring somebody else in. I'm just saying. Go get a loan, assuming any of these things are possible. Sell the company, roll it up, merge it, there's 50 other scenarios. But we need the time, collectively, to figure out what happens so that we're not in distress. Now, I have done deals where it's much less than 18 months, but those are companies that generate a lot of cash. Because remember, the number that I'm interested in is the zero revenue runway. I love that you think you're going to make all this money and generate all these sales. Let's assume you don't. Let's assume the amount of revenue you generate is zero. Okay, how long can you go with that money? Those are some of the low-end metrics that we're interested in. Of course, those are then relevant to the other ones, the distance to cash flow, distance meaning time in this case. How far do you run before you start taking in more than you're paying out? That doesn't mean you're profitable. That just means you're good at cash management. So, but still, it's one of those nice metrics.
About back to that hockey stick model, sometimes in high tech, you may want to plan exit before 5 years. In that case, are the investors still wanting to see the 5 year of the ongoing business? What is your?
I'm going to tie that back to my last slide because we're going to be there. The short answer is, again, you need to understand your costs. You need to show me that there's, one of the things that we're interested in, if your revenue goes up like this, but your expenses go up right alongside it, not really, oh great, okay, so every time I spend $1, I might make $1.01, but I might lose 90 cents. So I'm still interested in seeing what is commonly referred to as that hockey stick. I want to see revenue go up, but expenses not go up at that same level. I want to see that gap get wider and wider every time. That's what I'm looking for.
Even if I plan an exit before 5 years?
Well, absolutely. Well, what's going to happen is it's going to affect your valuation. So again, if you're basically showing that I'm only always making a 20% margin, you're going to have a low valuation. But if you show that margin gets much, much higher, you're going to have a better valuation. That's not to say that you have to, but again, it's just better for packaging a deal and having a business. Ultimately, this all wraps up in from what things we're interested in is okay. So now we've decided on the capital requirements. We haven't decided how we're going to structure it yet, but the capital requirements. And of course, I want to know what you're going to use the funds for. I'm probably going to put conditions on what you can use the funds for. The famous term sheet. And by the way, this depends on the type of funding. If I get it from Uncle Fred, he's probably not going to ask me for a term sheet. Probably won't even come to the board meetings, but you get what you pay for. So maybe that's all you need, by the way. So you keep all that stuff in there. And then ultimately, I also want to know about the current and proposed cap table. Who owns the company? Okay, what previous rounds have occurred? Oh, wait a second, those guys aren't investing in this round? Why? I'd like to know that, right? Because that's going to affect me. Well, what do they know that I don't know, and they've been in it, kind of thing. All right, so I understand they lost $20,000 in real estate, and they're trying to figure out how to keep their house out of foreclosure and all that stuff. I get it. Okay, that's all right. But as opposed to they saw something they liked and it didn't like and it scared them to death. Show me, I want to see that too. So before I put my money in. But ultimately, I want to see all of the transactions that brought you to where you are today, and then what's the company going to look like if I actually write the check. Okay, I think we're just about done. Okay, so ultimately, again, the investment readiness. So this is another one of those internal things for you guys. Theoretically, you should always be ready from an investment perspective, but not at the point where you're distracting yourself from running your business. I mean, that's the fundamental thing. You succeed on the success of your business. That's it. You get to thumb your nose at all of us investors because you succeed, or you get to pat the ones on the back that believed in you and put their money at risk and thumb your nose at the rest of them. So based on the success of your business. So please, stay focused on this. But you always want to be thinking about the investment. By the way, all of you that are furiously taking notes, the last slide does have a web link to this presentation. Sorry. Probably would have been useful information. My wife says I'm a bastard, and sometimes she's right. So I apologize if it is. We were talking about, so the viable business. Don't even call me. You don't have a viable business. And whether it's viable today or down the road, I want to see a real business with all that. And we do actually invest in ideas. And contrary to belief, there are lots of other folks that do as well. There's an interesting phenomenon, and David's organization is in the heart of all of this as well, and that is the idea of growing and investing in these people at very, very early stages and seeing that evolve. And again, this is not an age thing. This isn't, oh my God, you're over 27 years old. You can't do this. Wrong. Absolutely. I mean, it's not an age thing. Oh, you know what? I did want to come back. There was a slide here. I'm sorry. There was one thing that was relevant. I sort of left it hang. There it was. Relevance, time, and cost, commitment, and skin. Not the racial kind. So ultimately, when I invest, I hate being the Lone Ranger. I don't want to be the only guy at risk. In fact, I won't be the only guy at risk. I don't do that. There are investors that do. I want to see people that have skin in the game. And it's real. The concept's really simple. I want all of us to be on the same side of the fence. I want us all to have a vested interest in the cumulative success. I want you to have skin in the game. And I want to shift that risk and reward. So I didn't want to jump all the way back, but it's one of those important things.
Because do you have a ratio for that? Like, some people say, oh, I want, you have 10% of what you're looking for in, or 5%, or 2 years of sweat equity, or any kind of
there's no magical element in there. I mean, ultimately, it's different and unique for all individuals and all folks like that. I've done deals where I don't want to be more than 25% of the new round. I've done deals where anybody that wants to give me all of it, I'll take it. It is different with all that. And as far as founders, et cetera, look, if you come to me and say, I want 80% of the company, and we're not really generating any revenue, and oh, by the way, I'm going to take $300,000 a year salary, and you want my money to pay for all that? Again, not impossible, but you got an uphill battle trying to sell me. Okay, so these are the core things that I think that you need to be able to have prepared, certainly from a financial standpoint. And there's others that have talked and others that will talk about things beyond the financials. Yeah.
How do you establish a valuation on something that is largely conceptual?
There are ways to do all that stuff, and whether it's done through, I think those are, you're one slide away. And I'll come back and talk about that. By the way, you just defined the entire technology space. So, or the genome world, again, to me, the most important document that you have internally is the business plan that you don't show people. Okay, because this is your personal notepad, your personal scrapbook, your personal all of that stuff. But the most important external document you have is that concise 10, 12, 15-page presentation that's not filled with tiny little words. There's lots of famous discussions about, if you're using less than 40-point font. I don't actually subscribe to that. But again, we should be able to get our heads around it relatively quickly. Hit the core topics. And if you don't know what the topics are, just Google them. There's a zillion different things. And then make it relevant to what you're doing. Because there is no one template that's the best. It depends on the business. It depends on the people. It depends on what you're looking for, what you're trying to accomplish. It is unique. But there are common things that we're interested in from an executive summary perspective with that. But that's that document that you should be able to identify those 10 or 12 things that are core elements to this. What's my secret sauce? How do I make money? What are my projections? Who are my competition? All those things that go along with it, and focus one page, one slide, each one of those. So that's probably not enough information. That first slide I showed you with all that information is probably too much. Somewhere in between. And again, if you can't convey in 5 minutes all of the key elements of your business, it's too complicated. And by the way, we all hear about the proverbial elevator pitch. Absolutely true. If you can't drag me into that corner and explain to me about your business in 60 seconds, go back and try again. And I don't have to get it all, but I have to understand enough to go, ooh, that's interesting, tell me more. This goes back to the theory I was talking about earlier. Your job is to get people to say no, early, quickly. And hopefully you suck at that job. All the way. Financial projections, again, I absolutely want to see the details. I want to see that you thought it out. I'm going to look very closely at that first year. Because if that first year doesn't tie, the 5 years means nothing to me from that standpoint. I can absolutely, extrapolate out. If I see 1 year, I can extrapolate out what that 5 years is. But it's not me that has to do this exercise. And again, this goes back to the study and the learning and the knowledge base that you need to have. So, should you go 5 years? That's up to you. Should you go 3 years? Every single time, absolutely. At that point, it's not that big of a leap to go 5 years, but you know what? Don't just go in to your spreadsheet and go times 20% to the previous month. Okay? If you do that, you better make sure you have a page of assumptions that explains why this is justified. Because we're also seeing something about you, right? You came to apply to get a job to take my money, and I'm looking at behind the scenes. You don't realize that the application you're filling out is telling me so much information about you and how you're going to run your business and how you think about this. Did you slop through this thing and go real fast? I'm going to see it. Did you think it through? I'm going to see it. Is this stuff realistic? We're going to see it, okay? So it is worth the exercise, but don't make it this exercise of wasting all of our times with this. So the legal side of it, again, from an investment readiness standpoint, depends directly to the type of deal that you're going to do. There's some internal stuff that you need to make sure you do. Are you an entity? Is it formal? Is it legal? Is it good standing? All of those things. Does all the documentation and governance exist between you and your partners and things like that? Or that all gets hit with the term sheet. But again, you should be able to be ready for all that stuff. If you have a lawsuit sitting on the books, you better be explaining. You better bring it up and you better explain about it. Okay, because if we find it, end of story. But if you to tell us about it, that whole thing we were talking about earlier, communications, big win. Okay, from all that in terms of getting asked what could have otherwise been an end of a meeting. The pitch itself, you need to understand whether you're going to have that 2-minute pitch, the 5-minute pitch, the 10-minute pitch. It's not likely that you're going to get a whole lot more time with that in the early stages of the conversation. And again, it depends on the audience. Uncle Fred, as long as you're buying beer, will probably sit there and listen to you for hours with that. A busy VC, first of all, if you can get in the door, and by the way, the easiest way to get into a VC is have somebody else bring you into the door. Talk to your lawyer, talk to your accountant, talk to other businesses that you're friends with that have been successful with all that. Now again, this is game changing now because we have incubators where you can reach out and say, hey, I'm going to apply. I'm going to apply to Harvard. But in this case, it's, Hatchery or Paul Graham or whatever. So there's lots of different scenarios there. I got one last slide. We're going to deal with all that stuff. Who to pitch to comes back to what we were talking about earlier. You absolutely should go and understand the people that you're asking to provide money because there's this concept of smart money and dumb money. Dumb money, some guy behind 7-Eleven will lend you 10 grand. I don't know what value he's going to bring. Let's not even talk about the usury rates and things like that. But what value is he going to bring? Likewise, there may be an investor out there who has absolutely nothing to do with your business. I'm just trying to put some money to work. Now what I call smart money, because the value that they're bringing is measured in the amount of dollars they bring. But by the way, that's okay if that's what you're looking for. But if you're looking for a strategic partner, somebody that's going to bring more than money, that's what I call smart money. You've got to understand who that person is or that company or whatever. What do they do? What else do they invest in? So, look, you're going to go out and all this work and then just arbitrarily send out 50 pitch requests to the folks out there. Not realizing that this guy only invests in dog food and this guy only invests in not dog food. And again, understand the market, understand the people. Look at the deals they've done. Every one of these guys has sites on there that shows who their clients are. We like to brag about people we invest in, well, successes in anyway. So look and see. Look and see if there are synergies. The other thing that we as investors look at is we are not only looking at your company, we're looking at does it have relevance in our other portfolio companies. Because if there's a balance there, if there's relevance, then that increases the likelihood of success. Because if your thing doesn't work out, maybe I'll roll you into that. If theirs doesn't work out, maybe I'll roll them into you. So I'm looking at these synergies with all of that. How to close? There's no way we have time to talk about all of that. But you better figure that one out. Yes?
So you mentioned about portfolio, but should I go to a VC who's also funding my competitor?
So if the short answer is maybe, but you better be careful what you disclose. And by the way, you're not likely going to get a VC to sign an NDA. And the reason is we see so many deals. The last thing I need to do is have some guy sue me because I invested in this other deal which they didn't know each other. So don't show me anything. I mean, there may come a time where that becomes relevant, but early stages, nah, I'm not going to sign an NDA. So that's just me. I mean, there are certainly VCs that do that. I think we're on the last slide. Yes, I'll leave it. Sorry, I didn't even take so long, guys. And again, the dude who's not in his chair is wanting this schedule of all these points. So common deal structures. Well, There is no such thing as a common deal structure because every deal is unique. But there are some buckets that you can generally throw these things into. So we'll start from easy to complex. Self-fund. I got a credit card. I got a balance on it. I'm going to go to the ATM and I'm going to withdraw cash. And I'm going to hunker down, and I'm going to lower my expenses, and I'm going to focus on revenue generation. Radical concept. It works. Sometimes. Okay? When should you be real careful of that? You got a screaming kid at home and you just spent the milk money. Okay? So this is thing balance of life. Okay? Next level, founder fund. Okay? And I don't mean founder fund as in the VC out in California, the website. I'm actually talking about, okay, we're partners. I'm not a VC. We're partners. I'm a techie. You're a techie. We get together. We build something. We're going to now fund it. And we're going to do whatever collectively that we're going to do that. And that may be more formal than just going to hit our credit cards. But fundamentally, we're going to rely on us to do all of this stuff. Friends and family. Easiest way to get money. Easiest way to screw up a family relationship. So, I don't know, guys. Again, 9 times out of 10, it doesn't work. But 10 out of 10 companies I've run into have done this at some stage in their life, it seems. And it just seems to be the thing. Be very sensitive of this, okay? Again, I said it earlier on. I get it that you risked all your money, and I get it that you asked Uncle Fred to risk all your money, and Fred's easily talked. No, you could be an idiot, and now both your money's are gone. Nothing personal. So, again, you just got to be really careful with all of this stuff. Don't do things that are going to risk your ability to go forward, in a reasonable way with this. So it's the old bet the farm thing. Be very careful about betting the farm, and that's where that saying comes from. So customers is another great way to tap into financing. Okay, they have a vested interest in your business. So I got a relationship. I got a customer. He's doing $10,000 a month with me, and I'm giving him a price, and I'm thinking about doing funding. It is absolutely okay for you to consider putting a funding package together. Look, guys, I'm trying to raise $50,000. Here's what I'm interested in doing. You've got a vested interest. Here's what I'll do. If you give me the $50,000, I'll give you a couple of points. I'll give you a 20% discount for the next 6 months, and blah blah blah. Whatever the deal is. Now you got to be careful because you don't want to scare that customer. Oh, you need money. Oh shit. There's a balance. That was a technical term that slowed down. So there's a balance, but customers are absolutely a viable place to raise money. Now, I have seen large funds, large amounts raised, but only with large customer relations. It's a risk, but it's also viable when you start looking at various different options. So now we have angels, and now this middle concept known as super angels. I'm not sure what the exact definition is. Depends who you ask which time of the day with that. But these are folks typically that are, they've been successful in life. They may or may not have retired, and they're interested in continuing on. Very often, these are guys that are interested in being involved in mentoring as well. And there are investor groups throughout the world, certainly throughout the U.S. and here in Florida. There's a great one up in West Palm. So there's a number of different ones here in this area. David has more than a few ties to some folks in their area. Some investors have geographic issues. Many do not. So just be aware of those. But this is typically easier money. This is not as difficult as a VC, but it's not as easy as it used to be. Oh, yeah, that sounds great for you. No, not quite that easy. So a bank, this is one of those catch-22s. If you were in good enough shape to pass it to a bank for them to write you a check without having to give up your house, then you probably don't need the money anyway. So there's kind of that balance, but it's still a financing. And then you have the VCs. So a good VC is a very, very good thing for you in business. A bad VC is the kiss of death. Okay, and I've been in deals where I've bought my VC partners out. And I have VCs involved in businesses I do that I will not do a deal unless I can get these guys in. So it works both ways. Again, know who you're doing business with, know what they bring to the table. They're always smart money or smart ass money. Usually smart money. It's expensive. But they're risk takers. This is what they do. Okay? But they're going to help you to realize your vision. And if you roll off the track, they're going to slam you back on. And I say that respectfully because that may be what you need. Again, I'm not picking anything. Yeah.
How much equity do investors, angels, or VCs typically want?
Well, so that goes back to the A plus B plus C divided by D, valuation, what are you willing to give up and everything else like that. There are some axioms, however. It turns out that, let's say there's a $3 million valuation company. Okay, it is just as much work, arguably more, if I only invest 100 grand as if I invest $1 million. So, wait a second, my potential return is 10 times for the same amount of work. Which one do you think I'm going to do? So there's a balance. So if you want me to do that smaller amount, you better make the deal more attractive with all of that. And then there's the other risk factors, and again, me looking at are there synergies and other ways to mitigate my risk with all of that. On the other hand, when you start getting traction, it's not uncommon that you could get, you could offer 20 or 30% of your company and have a consortium of VCs come in because they want to spread their risk, and they'll each take a couple of points or 5 points or 10 points or whatever. So each one is a little bit unique, but it's very, very hard to have a company without a whole bunch of traction go out and sell a couple of points professionally, not the Fred, but professionally. So.